During these pandemic times, heard some real stories, struggle stories there, and how they're navigating their way during these times. And F&B was one of the most impacted around the world. And you've seen this up close and personal. What do you sense the recovery is going to be?
Uh, well, Archana, to be honest, the F&B industry was actually the first to get hit. Restaurants closed well before lockdown was announced because we started sensing an issue. And we were also the last to stand up, unfortunately. During the period of lockdown, our teams, our people were incredibly scared to come back to work, and that continues to be an issue today. While we have reopened, restaurants are one business that can't work from home. But while we have reopened, the future ahead is still very uncertain. And I think for us as entrepreneurs, with the global economy in recession, the paramount task that now lies ahead for us is to revive and nurse the Indian economy back into a steady condition. And on that note, our first session for today is a captivating session on rebuilding the Indian economy. It's one of the most awaited sessions of this year's conclave. Our keynote speaker is Dr. Raghuram Rajan, all the way joining us from Chicago today. Dr. Rajan is the Catherine Dusak Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He was the 23rd Governor of the Reserve Bank of India between September 2013 and September 2016.
And engaging with Dr. Rajan in this very exciting conversation is Mr. Deepak Parekh, Chairman, HDFC Limited. Mr. Parekh's astute business acumen and farsightedness has made him a pioneer in the banking space. The government of India has honored Mr. Parekh with one of the highest civilian awards, the Padma Bhushan, in 2006. Over to you, Mr. Parekh.
Hello and welcome everyone. I would like to thank the Ascent Foundation and Harsh Mariwala for inviting me today. In India, we have a number of entrepreneurs and startup ventures, yet we do not have enough of support and mentoring for budding enterprises. I commend Harsh's efforts and the passion he brings in helping Indian entrepreneurs. There are two ways of learning by doing and learning from doers, which is the core belief of the Ascent Foundation. Today, on behalf of Ascent Foundation, I have been given an exciting task. I'm in conversation with Dr. Raghuram Rajan. Raghu is just not an economist, a teacher, and a former central banker. He's a thinker, a man of ideas and futuristic thoughts, and he has always had an ability to convey his views in a simple and lucid manner. Thank you, Raghu, for being here with us.
Thanks for having me. Thank you.
So we have a few questions for you, Raghu, and I'll try and make this more of a conversation and exchange of ideas, although I realize that the audience would like to hear more of you and less of me. So before I move to the question, I do want to share a few thoughts on the role that RBI has played since the outbreak of the pandemic. There is a unanimous view that RBI has certainly shouldered a great responsibility and responded to the needs of the market, be it in terms of infusing liquidity through repo operations, special open market operations, LTRO, targeted long-term refinance operations, increasing refinance limits for housing finance companies, agriculture, MSMEs, backstop facilities for mutual funds, truly doing whatever is needed. So if I look back from where we started at the point of the lockdown to now, I think the worst is clearly behind us. Almost every high frequency indicator suggests a clear recovery. The bounce back that one has seen in housing, for instance, which is my forte, in the months of September and October, reaffirms the belief that this is not a pent-up demand, but the inherent demand for home loans remains strong. For instance, in October, we got 40% more applications for home loans than last October. In September, we got 25% more applications than pre-COVID September. So, and the reasons are interest rates are a 15-year low today in India. Property prices are softer. Various states have given concessions in stamp duty and property taxes for a short period of time. And fiscal incentives on home loans are always there, like interest deduction and part principal deduction. As you know, the government also has come up with a subsidy scheme there couldn't be a better time today, according to me, to buy a home. One could take so many indicators, e-tolls, e-way bills, GST collection are back to normal, fuel, power consumption, auto sales, tractor sales, and I can go on, return of migrant workers, that the growth trajectory from here onwards should be positive. So that's a key positive according to me. So the next question I want to ask you is, you are known to be an out-of-the-box thinker. How should governments be thinking about raising resources more effectively?
So first, I'm very heartened that we are having a recovery, and it is a strong one. And I would be little. I mean, I'm naturally more cautious than you are. You are a very effective banker, and I'm not. But I would be a little more cautious on the medium-term trajectory of the economy. Clearly, we had a very, very severe lockdown, and therefore not much activity happened. There is pent-up demand. How much there is, we don't know. I entirely agree with you that conditions may be quite propitious right now to buy, especially if there's some price flexibility on the part of the sellers. There is easy interest rates and so on. I do worry a little bit about the weaker sections of society through this process. Do they have the same sort of incomes, access to spending power? I mean, if you look at consumption, for example, meat, eggs have fallen quite considerably, 20% or so, even in August when we had started the recovery process. We have to track it carefully, make sure that we don't have a segment of the population which is sort of shut out for some time, because these are the people who work in restaurants, who work in hotels, who aren't seeing their livelihoods come back until we deal with COVID. So in that sense, I would say that, the sustainable level of demand after the pent-up demand, after some of these sort of incentives go away, that's also what we have to be worried about, the medium-term growth. But I'm very happy that we are on some kind of recovery path. One concern to be worried about is a resurgence of COVID, which we are seeing across the world. And of course, that would again dampen. The second issue to be worried about is the debt burdens that have piled up in companies, especially the small and medium ones. There's a lot of forbearance. So are they able to pay when the forbearance comes off? Are the households able to pay? That's what we have to watch. I have no doubt, again, there are people with buying power. They're expressing it. That's good. But what about the ones who don't? We have to be careful. Now, on the financing, I mean, India has always lacked for risk capital, right? The large quantities of risk capital that we need for the growth that we need. But I would say that as much as risk capital, we also have to de-risk the nature of projects. When we look at infrastructure, why has infrastructure gone into so much trouble? Because it's subject to so much risk that doesn't exist anywhere else. I mean, look at land acquisition. That's fraught with danger in India. If you don't have the land, it could take anywhere from, whatever the project postulates for the time taken to, 10 times that number. Second is government sort of actions, with power projects, the power purchase agreements that the state governments have agreed to. Well, they agree and they disagree. So how are you going to take that risk into account? So my sense is, as much as finding new sources of financing, is de-risking the existing project structure, a lot of which can be done through reforms, but also, much more constraints on government action. How do we do that? That's what we have to look going forward. We can talk about the specifics of financing.
No, I entirely agree. The big issue is that will we have a resurgence of COVID? Will there be a second wave or a third wave till the vaccine is freely available to all the people? So that's a big risk. And we see in certain cities like Delhi, Ahmedabad, where the numbers have gone up significantly in the last couple of weeks. And Diwali is just over. And, there could be a spurt in cases. Although Bombay is better, but, it takes 4-5 days. Diwali is just over. So we're watching carefully whether we can avoid a second wave. And so my comment here, Raghu, is that we need the stimulus, and yet we need to be careful with fiscal spending. particularly from the perspective of sovereign rating, because international rating agencies, as you are aware, are concerned about servicing of government debt. We know that piecemeal ways of divestments and reluctance of inherent difficulties are there with privatization. So fortunately, the government has come out very openly now that this year, the Honorable Finance Minister has made a statement that in the current financial year, they will totally divest in Bharat Petroleum and Concor, and not just privatization. So, here the point is every private entrepreneur, every promoter normally borrows against his equity from NBFCs. It's a big activity for NBFC in the private sector. They pledge their own shares and they get money to reinvest in other projects or in the same company. In the same vein, perhaps the government could pledge its listed PSU shares with the Reserve Bank and till they privatize, and it's an advance against privatization, it's an advance against sales. We are talking of a large amount to unlock because it will be vast resources. Just to give you an example, UTI got into trouble in 1999. Vijay Kelkar was the finance secretary. He called me from Washington, World Bank meetings were going on, and he said, why don't we form a small committee and tell us what we should do? The simple thing that got UTI in trouble was buying government shares. 1999, government started selling 5%, 10% NTPC, Bharat Heavy Electricals, Indian Oil. And they bought 3,300 crores of PSU stock, which had crashed half. And so there was a run on UTI. So we just put those same PSUs into an SPV. Government gave government guaranteed bonds, which UTI sold to meet the repayments. Now those stocks in that SPU over the last many years have recovered and the government has made adequate money. So the point I'm making is government can use its stake in ONGC and Indian Oil, which are large corporations, to raise money. That was the point I was trying to make. Anyway, we move on. Yeah, sorry.
It's a good idea. There is actually a government ETF, right, which holds public sector shares.
Yeah, something new.
Instead of going via the RBI, they can just put all their shares into a bigger ETF. And then as they privatize, basically the ETF, essentially sells those shares into the market. That would work also. And the advantage of that is you don't have to go through the RBI. The ETF itself, at this time of rising prices with, money power in the hands of some of the wealthier people right now, not knowing what to do with it, they could invest in the ETF. So I think there are ways without doing the full formal privatization. Those shares are already traded. There are minority shares that are traded. Put them in the ETF, let the ETF sell more shares directly to the public. You've raised money. The problem with the privatization is we always announce the privatization, but nothing actually seems to get done. By the end of the year, we say, okay, we've done nothing. Next year, we'll do twice the amount. Then next year, we triple the amount. Nothing actually happens. So unless the bureaucracy is ready to go, it'll always happen. The stock market is down, so we can't do it now. And then when the stock market is up, we start the process of trying to get everything into, and by the time we're ready, it's gone down again. So, we'll never privatize unless there's a will. And the will has to come from the top. It has to say, thou shalt be ready. As soon as you're ready, we'll start selling in the market. You can't time the market perfectly, but why aren't we selling now? The market's reaching all-time highs. Why aren't we selling more? So often with well-managed entities, selling shares to the public, to my mind, makes a lot more sense than selling to one large entity, and which creates a whole set of political issues. Who did you sell to? Are they connected to you or not? You remember all the problems that we had in the early 2000s. So I would think in most cases, strengthen the governance and sell the shares to the broader public.
Okay, now what are your views on using our foreign exchange reserves towards infra funding, or perhaps starting our own sovereign wealth fund?
I think that, both are, first, the RBI sort of putting some of that money to funding infrastructure would be a complicated process which may not work out that well. Montech had this idea, if you remember, a number of years ago. The problem is that, let's say you're an infra company and you're buying, domestic land. That's what you need the money for. I sort of, as RBI, it's very hard for me to lend to you because let me sell some of those foreign exchange assets. Now, you're not going to buy that foreign exchange. You want rupee loans. And so what happens is I have to reabsorb those foreign exchange assets, and at the end of it, I haven't got rid of any foreign exchange unless I'm willing to see the sort of rupee appreciate versus the dollar. Essentially, part of the reason we have such large foreign exchange assets is we are absorbing dollar sales. And as a result, we are trying to keep the rupee from appreciating too much. If we sell those assets in order to finance, then somebody has to absorb them. And part of the problem is nobody's willing to absorb them right now because we are running a current account surplus this year. And as a result, so it creates difficulties. I think your second point that, a sovereign wealth fund, but it wouldn't finance local infrastructure. What a sovereign wealth fund would do is allow us from holding low return sort of US Treasury bonds to maybe holding equity. Now, again, RBI is not at this point well positioned to buy equity, but we could certainly set up a separate capacity there as our foreign exchange reserves go up to invest in equity. We contemplated investing in equity ourselves when I was governor. Okay. We decided that, it was early days, but we should prepare the capacity so that we can invest in a broader set of assets for the nation's good.
Yeah. So my point here is that our reserves, foreign exchange reserves, have been increasing quite rapidly. And presently we have about $568 billion of reserves, which are the fifth largest reserves in the world. As a country's reserves are concerned, I agree, safety is paramount. Yet the earnings on foreign exchange assets, last year's balance sheet of RBI is only 2.65%. This year it will be even lower. We have to find ways to earn higher than 1-2%, which. So I would agree. I would think that I truly believe actually that India's time has come when we set up a sovereign wealth fund. Say with 10% of our reserves, only 10% of our, and as you say, set up a good team under RBI. They can buy equities, they can buy corporate debt overseas. It has to be overseas investment. It can't be in domestic. It cannot be used for infra, as you said. But I think the time has come when we should look at a sovereign wealth fund is to have savings for the future generations.
I would not disagree. And I think that, the advantage, one of the concerns that I have is that with all the flows that's coming in, the rupee is probably stronger than one would want from an export perspective. I mean, if you look at Brazil, it has depreciated 30%. We don't want that kind of depreciation, but we don't want a rupee which is too strong in real terms. So some sort of depreciation over time would be good to maintain our external competitiveness. And one way to do it is to let more money go out. Now, we tried to do this through the LRS systems. People could take their money out, but there could be other ways to let the pressure go. And one way would be a sovereign wealth fund which buys outside when a lot of money is coming in.
Okay. Next is, what do you think is the right institutional mechanism for funding infrastructure? There is debate that should it be the government, should it be the private sector, should it be PPPs? India has tried all these variations and still we do not have the right answer. Do we need to resurrect DFIs again? What we had in the good old days of IDBI and ICICI.
I mean, the history of those, right? I mean, that they worked well when there was subsidized financing for those institutions. But as the subsidies came to an end, they wanted to move more towards a banking structure because they believed safe deposits would be the way to finance some of this infrastructure. I mean, the reality, I think, is, yes, we've tried different ways. Part of the reason is what we talked about earlier, that we have to de-risk our projects more. Right now, risk embedded in infrastructure is huge, and we try and finance it a lot with debt with very little equity. If your risks are huge, you need far more equity to finance it. And obviously, that leads to the other difficulty. We don't have so much equity finance available in the country. Risk capital is limited. And so I would argue that, to my mind, it's not so much setting up new institutions. De-risking on the real side. On the financial side, I think we do need to develop far stronger project expertise, not just in the banks. Banks also, they follow the herd for the most part. The private banks don't lend too much to infrastructure because they know that's how you get your hands burnt. The public sector are coerced into lending into infrastructure, but they all rely on SBI caps or IDBI to give them their opinion without having a separate opinion, which creates huge problems in the sense of, if the due diligence is not done properly. What you need in some sense is first strong capacity to evaluate in each bank. And second, some of the funds, the LIC, the, large pension funds, large insurance companies should also participate in this process. But we need definitely a good system of capacity building to make these kinds of loans. I won't go back to the old public sector,
Sure.
IDBI, quasi-public sector, ICICI. It seems to me that we tried that, didn't work. Maybe try one again. But really, I think de-risking as well as improving equity buffers and doing better due diligence.
Now and again, you keep hearing about some idea that, we need a DFI. The infrastructure companies keep saying we need a DFI. But, as you said, DFI's funding mechanism was government guaranteed bonds. They would get bonds which they would float, which are guaranteed by government, eligible for SLR, and the banks bought them. So that was the funding mechanism of most of the DFIs. Now, I want to ask you, I know you were as crazy about cricket as I am. And in your early days as governor, I even saw you in an IPL match in Delhi. In Chicago, have you followed the IPL? Do you follow cricket, or you are now at biking or running?
No, I unfortunately, timing of the matches doesn't permit me to watch them, but I watched the highlights. So I was a regular follower of the highlights, the 6-minute short form. It's a little, just watching the sixes being hit is not as exciting as watching the overs and so on, but it saves time. With COVID, one of the good things is tennis is still open. So because it's a large
open,
and so I play tennis, running, of course, when the weather permits. In Chicago, it's now getting down to the -3, -4. So that becomes a little more difficult. And of course, biking is out of the question in this weather. But yeah, you try and keep yourself healthy. But yes, I remember the World Cup, which you invited me to in 2011, and
left half an hour or 15 minutes before the close.
Well, so that is my conservative. I said I'm conservative, right?
Yeah.
I had to go back to teach in Chicago. Yeah. So I left when I knew India was winning, 3 or 4 overs left, and I heard of Dhoni's 6 in the car. And then, when I went onto the plane, got on, etc., way later, I found next to me was Nazar Hussain, who, had left half an hour or 1 hour after the match was over and still managed it. And then I felt very bad. I've been too conservative in getting away from the stadium.
The world is now close to about $15 trillion of negative bond yielding bonds. Why isn't more money not flowing into emerging markets and earning higher returns?
It is, I think that right now, if you look at emerging market debt this year, like industrial country debt, it's going up by a huge amount. As you know, many of the developing countries in Africa are already in deep trouble, having borrowed in this period before the pandemic, and now being, in dire straits. Yesterday, a few days ago, we saw Zambia default. We've seen Venezuela, of course, is a basket case. Argentina is in trouble, but a large number are now getting into trouble. Now, coming to the issue of India and its sovereign debt, yes, we are going to see sovereign debt go up to 85-90% if you take the state and central government together. But this is an opportunity for us to say, okay, we are going to get our fiscal house in order. Here are things we are going to do to assure investors in our debt that over time, we are going to bring the house into order. But what is important, and this is a trade-off many countries have to make, I do need to spend now. If I spend now, I increase my debt. But at the same time, I can also increase the rate of growth. If I have good projects to spend on, if I have good worthwhile reasons to spend, if I can increase that pace of growth, it may be better than having that low growth and not so much debt. In other words, what we need to see is how much growth that spending can buy. And I think we are probably on the side where a little more judicious spending on the right things could elevate our rate of growth.
Sure.
But to keep the markets confident that we're good for repayment, we have to do a little more in the sense of convincing them that we'll get our fiscal house in order. Part of the problem before the pandemic was that we spent without showing that we spent. The public sector borrowing requirement was close to 9 or 10%, which is how much the government actually borrows. But what we showed was far lower than that. So it looked as if we were fine, but we were not. The CAG pointed that out. I think we have to recognize those lessons and not sort of wave hands and pretend everything's all right. Come clean. Here's my fiscal situation. It is not great, but I will get it back into shape. And here are constraints that I want to impose on myself. The finance commissions have always talked about a fiscal commission, which will opine on the quality of the fisc and introduce greater transparency. High time for doing that. Why don't we do that? That could give more confidence in India's fiscal situation.
Okay, if we move to the stock markets, global indices are touching all-time highs. Even in India, we've touched all-time high. There's too much liquidity, spiraling prices upwards. Is it a reflection that recovery is faster than expected, or it's just too much money chasing too few good stocks?
You're a better expert on the stock market than I am, but I would guess it's a bit of both. I mean, for sure, the extent of central bank provided liquidity has pushed down the interest rate. And after all, when we discount stock, profits of companies, we are discounting by an interest rate. The lower that is, the higher the price we're willing to pay for the stock. That's one. Second thing, at these low interest rates, what matters is survival of the company, right? If the company is going to survive for a large number of years, then 1 or 2 years of bad profits doesn't matter, because you're valuing the longer term profits at a high value, given the interest rate is low. So the second thing that central banks have done, what you referred to earlier, is essentially pulled out all stops in helping firms. Lots of there's over $1 trillion worth of corporate debt, issuances in recent times in the US, and that's allowed these companies to survive through a period of low profits. The third thing, I think, is the stock market is a partial image of the economy. It's usually larger firms. In the US, largely, tech firms are a big portion of the stock market. Pharmaceuticals are another big portion. So it looks very healthy. But if you look into the details, you will find there are lots of unhealthy firms there. And then below the stock market, the iceberg below water consists of a lot of small and medium firms, which I believe are in more trouble and that will come out down the line. Now, if you look at the regulators, they're saying, don't be too quick to start your dividends up again. They're telling this to the large, banks, saying there is still trouble to come. Now, again, regulators like, I was an ex-regulator, might be overly conservative, but it is unlikely that with the kind of revenue falls we've seen, there will not be any trouble going forward.
No, I agree that the large in India also, the technology stocks and the pharmaceutical stocks have really gone through the roof, and there is a lot of foreign money coming in, foreign portfolio money coming in. Recently we had a discussion where the finance minister, the prime minister were there, and there were 21 sovereign wealth funds and pension funds, the largest. And most of them were saying that our exposure to India is very low and we want to increase our exposure. So there'll be more funds coming from overseas, which increases the price because the liquidity is also limited. Indian promoters want to keep 51%. They don't want to sell. And, LIC being a traditional shareholder, they don't sell. They're in most companies, they have 5, 7, 10% of shareholding. Now, a little bit about technology, what you are seeing in the US and India, we have large number of young entrepreneurs, and technology is going to even play a larger role in any business. What is your take on the talk in the US around the need to split the large tech companies?
There are a number of reasons people have turned 180 degrees on these large tech companies, right? There was, in the early days, they were seen as brave new firms. Google saying, do no evil. That resonates amongst young people. Oh, this is a different corporation.
Yeah.
But then what they've seen is the accumulation of power in these corporations. And then when they say Mark Zuckerberg having the ability through, a flick of his sort of dial, changing what you see. And there are increasing stories about how these tech companies are promoting addiction. You see this clickbait, you see a story and then you're addicted to following another story and another story. And they're trying to keep you on the web rather than let you go, even if you have other better things to do. Examples of their market power, and of course, their fantastic profitability. All these have raised concerns on both sides of the aisle in the US. Both the Democrats are unhappy because of all the fake news. The Republicans are unhappy because they're censoring, that some of the trolls and the fake news have been censored. The bottom line is nobody's happy. And I think the problem to some extent is that the government should have looked at this industry more closely as it grew in size, but effectively gave it carte blanche to do whatever it wanted, even protected it through legislation. That may have been good for the growth. Now that they're monopolies, they're getting very worried. And the worry is not just about their behavior, but it's also about their political power. And so the US has this tradition when companies get too politically powerful, there is widespread desire to cut them down to size. It happened with Microsoft, it happened with IBM, happened with AT&T. And I think it's happening now with the tech companies. So you will see a lot of inquiries. Congress will try and pass something. I doubt it'll be easy to break them up, but they may separate something. So Amazon web service, cloud services may be separated from the rest. They may force some rules on the platform. You can't put your sort of results first, or there must be a protocol on this. There may be some of that. But severe break,
I agree.
Break up into 4 engines doesn't make much sense from an efficiency perspective.
Sure, I agree with that. Now, what advice are you giving your students, your young students who would be looking for jobs against the backdrop of this pandemic?
I mean,
it's a tough year to graduate. It's a tough year to graduate.
It is. Now, first of all, let me just finish the thought on tech, that there is an opportunity for India. I mean, what we're seeing from how we've reacted to this crisis is a lot more can be done at a distance. Industrial countries, 45% of work is done at a distance. Now, that is an opportunity to emerging at a cheaper cost. Now, we have to establish trust, but telemedicine, for example, up to about 20% of medicine now because of COVID, can't we do telemedicine from India? So this is an opportunity for us to rethink what services we expand in and how we build trust. I mean, do we get lawyers who have US degrees starting to service from India legal help, or medical degrees? Could doctors come back to India and then offer medical help after having obtained degrees, the appropriate certification? On our people graduating, this is a really tough year, and the history of people graduating in bad years is that almost always it hurts their career. It affects their career. They come out, they take time to find a job. The job is not the best job they could get. Starting in a second-tier job means you never really make it to the first year, and so on. So that's problematic. The flip side, of course, is many more are thinking about jobs that have social content. They are trying to see whether they're going to make a difference in the world. So mixed bag. I mean, the careers, fewer jobs there. I'm sure as we see the recovery, and if the recovery is as strong as you suggest, there'll be plenty of jobs around. But it's also a time for people to reflect and say, what kind of world do I want to see, and can I do something different in order to change that world? So it's an interesting time. I think lots of opportunities, of course, challenges also.
So what advice would you give to business leaders as they navigate through this COVID-19 crisis?
Look,
Be cautious.
Far be it from me to give advice, but look, I want to maybe implicitly give advice by pointing to something. In the early 2000s, right, I remember my frequent visits to India, I used to come back with a sense of possibilities. There was always a sense, India is coming, India is coming, India is strong. Bharat Forge is competing with the best in the world. We're doing fantastic things. Cost of production is falling. Nothing can stop us, right? More recently, I sense much more pessimism. Oh, the Chinese are crowding us out. We need to tariffs on them. Oh, we can't compete here. We can't compete there. I think the optimistic Indian businessman can do far more than the pessimistic Indian business person. And if we adopt that optimistic attitude, I mean, nothing can stop us. We need to get back that confidence. And there are examples. I mean, I keep reading now about Royal Enfield, which is creating a market in the US. I mean, fantastic. They found some way to do this. And there's so many other possibilities. So I would love to see Indian business not say, oh, we have so many problems, but there's so many opportunities. And now that China wages are increasing, etc., there are lots we can do. Of course, there has to be some kind of enabling sort of infrastructure, enabling environment, etc. But let's not get pessimistic. I mean, we can beat the world if we put our minds to it. Of course, we don't have a God-given right to beat the world, and we're not the chosen people. But we can do really well, and there are lots of low-hanging fruit. I would love to see consequence of the pandemic. Okay, going this way is just going to take us further down. Let's be optimistic. Let's push forward, and ask the government not for sort of tariffs or SOPs, but for better infrastructure, better cleaner business environment, an ability to forge forward rather than back. And that's why the idea of Ascent, to me, getting our young entrepreneurs on board. Mr. Mariwala is doing a fantastic thing with this.
Okay, you patented Dosanomics. How does this theory work against the backdrop of this pandemic? Now, India, we've had a bumper harvest this year of nearly 292 million tons. Yet food prices have continued to increase beyond seasonality factors. How does one explain this? The common answer to this is that there are supply bottlenecks because of transportation, because of the pandemic. And the farmers, although with the agriculture reforms, the farmers, as you know, can sell their produce anywhere and to anyone, but still the logistics have to be worked out. And I think that the reason is, despite the granaries being full, the warehouses being full, a bumper harvest, we see in some commodities like onions and potatoes, the prices have really gone up. And these are products which every household uses for Indian cooking. So how do we manage this? With bumper harvest and full warehouses, the price should really come down of food grain.
Yeah, I mean, I obviously am a little distant from what's happening, and I don't want to opine too much on inflation. That's the RBI's prerogative, and I've sort of tried to stay off trying to comment on the RBI. What I think is going on is partly these temporary factors. I don't think the agriculture reforms have played out yet, so I don't think that's a big factor.
Yeah, they've just been introduced.
Exactly. I think the vegetables in temporary short supply, even grains sometimes, because of our reluctance, FCI, once it gets grains, doesn't want to actually sell them. So it's very interesting, I would say, rather the food ministry, getting the food ministry. I remember a time where grain prices were going through the roof. We were trying to get the food ministry to sell. It was impossible. They just didn't want to sell. There was an order from the finance minister, do sell, we will compensate for any short. They won't sell. So it's somehow there's an element of hoarding the food ministry sometimes, which needs to be corrected. And I don't know why that is. But I think it's deeper than that. I mean, to my mind, one of the things we have to pay attention to is core inflation has been also quite high for some time. And if you look at the trajectory of inflation, it has been going up since December 2018. So there is something else that is going on. I think that's partly why the RBI is cautious right now. My sense is we have to wait and see. It may not just be a temporary factor, but I don't know enough to have a strong view on this. I do think the wait and see attitude is a good one.
Right. Okay, now every economist has an alphabet to describe the economic recovery, whether it's a V-shaped or a W-shaped or a U-shaped or an L-shaped or a K-shaped. What is your take?
Look, I think that I would be sympathetic to people who say there's a K-shape, that some sectors are recovering very fast, are doing very well. We hear about it, and some sectors are not. But the K-shape means that if some sectors are not for some time, that's going to hold back the overall recovery. Because after all, they're a source of jobs, they're a source of demand. So if the waiter is unemployed for the next 2 or 3 years, he doesn't have an income, he can't buy anything, and that eventually impinges even on the sectors that are doing well. So I do worry about the sectors that are not doing well now, and I do think that we have to be careful that they don't emerge from the crisis so atrophied that in fact they are a long-term sort of burden on growth. So we need to look at them more closely and do what is necessary.
Hospitality, civil aviation, restaurant business, in India, there's so many mom and pop shops and hawks and all, they've all disappeared. And the small restaurants where majority of the people depend for their food, lunch at workplace and all, I don't see them. And restaurants were not allowed to open. Now, selectively, a few of them are opening, but there is reluctance of people going because of the fear. So It's going to take time for these sectors to come back to normal. And it may even take 6 months to a year. And we have to support them and we have to give stimulus to some of them so that they retain jobs. In England, the government is paying workers of restaurants. And some portion of the salary is being paid by the government in order for them to sustain their livelihood. Now, it'd be too much for us to do that, but at least we need some fillip, some incentives, some stimulus to be given to some of these sectors. We've been hurt very badly with this.
Right. And I think if you can do it if you could target the people who are without livelihoods at this point, both in urban and rural areas, that would be also a stimulus for buying because they would spend whatever they get. So it would have a morally beneficial effect. We are helping the weaker segments of society, but they're also spending that helps, increase activity. I do worry that, surveys are all over the place, but at least some of them suggest that income levels for the weaker segments have fallen and consumption is also falling, which is very worrisome.
No, the government has come up with giving large number of people in pre-rice or wheat and pulses. And this program is going on for the last 6 months, which also helps to reduce your stock levels because the Kharif season is on and you will replenish the stocks. So I think that has helped the poorer community very much. And we hear from our people who have got families in the villages that at least that system has worked well. And families are getting grains or rice or wheat. It's an option whether you want rice or wheat. Every month they're getting something. Yeah. So that's a good scheme. So finally, Bombay or Chicago, what's your preference? A central banker or professor?
I think each one has its charm. Back and forth. That seems like a good thing to do. Look, I think the job at the RBI was probably the most fulfilling job I've ever had. And, I keep saying that, at the end of the day, when you left the building, many days you felt you had moved the needle. There are very few jobs where you can feel that, right? Where you've moved the needle and you've seen it move that day. So that was very fulfilling. But, I'm perfectly happy as a professor also. And there's so many exciting things to talk about and exciting people to talk to as we are having this conversation.
Good. Thank you, Raghu. It's a pleasure to reconnect after some time. And it's a pleasure to have a conversation with you. Keep well, stay safe, and hope to see you soon.
Same to you. And thank you again for having me on this.
Take care.